Good morning, everyone. We're back again. It's Wednesday. If you have forgotten what day of the week it is, it's that time of year. So we're in lockdown. We're in Groundhog Day. It's pretty hard to work out what day of the week it is. So, yeah, day three. It's 10 o'clock again. We're back again Thursday and Friday for 2 more webinars. But today we're concentrating on ESG, sustainability, impact investing, all those great words which I don't necessarily understand, which is why I wanted to do this webinar this morning, to try and understand a little bit more about this area of investment. So, as I say, we've had day 1, day 2. You can watch the videos if you haven't seen them online on our website. Please go and check those out. But today is a very much a particular theme that we're looking at in our continuing series of New Year tax year end webinars, looking at EIS and SEIS. So as you can see on your screen, we have 4 fantastic panelists for today. So let's go and meet them. Abby, ladies first. We'll go with you. Do you want to say hello and who you are, please?
Thank you, Mark. Yes, I am Abby, as you said. I am from Velocity. I'm the CFO, so I deal with all things finance for Velocity and our underlying companies as well.
Brilliant. Thank you very much. I'm going left to right. So Ian.
Hi, thanks, Mark. Hi, guys. Yeah, Ian McLennan. I'm a partner at Triple Point. I run our ventures team, and I think Mark's invited us here today because I'm heavily involved in managing our Impact EIS service.
You are absolutely right. Correct. Thank you very much. Chris, you're next.
Yep. Good morning, everyone. My name's Chris Armfield. I'm an investment specialist at UBS with a particular focus on sustainable or ESG investing. And I also sit on our EIS and VCT panel.
Lovely job. And Max, last but not least.
Hi, I'm Max Middleton. I'm an investment manager at Valor Capital, the appointed investment advisor to both the Vala EIS portfolio and the Vala Sustainable Growth EIS Fund, which is a newly launched fund focused on early stage investments into EIS qualifying businesses with products and solutions driving forward a more sustainable future.
Thank you very much. So look, we're pretty much 4 investment managers all concentrating on this area that we're talking about today. Let's say the focus this day is on ESG and socially responsible investing. We've seen funds that are focused on socially responsible investing steadily on the rise in the last few years. So we're going to look at why this area is growing so quickly and what the key points are and why you as a financial planner might need to understand to be able to help advise your clients competently and confidently. We're hopefully going to lift the lid on this relatively new area of investment for EIS and SEIS and give you some insight to take back to your clients. So let's kick things off. Let's kind of go back to basics, if you like. Chris, can you help kind of clear up some of the terminology here? So, you know, I've kind of loosely labeled this panel as ESG, sustainability, impact investment. Do they all mean the same thing, or do they have their own separate terminology? Help me out here.
Yeah, so the terminology around sustainable or ESG investing is an absolute minefield. It's a word soup. There are many managers who will use different terminology but mean the same things, or use the same terminology and mean different things. The way we typically view it, though, is sustainability or sustainable investing is the subsuming headline, and it covers a very, very, very broad range of topics. But you tend to find that ESG is the topic that comes out when you're talking about investing. So that's the focus on environmental, social, and governance. Now, perhaps if I take you a brief history of what sustainable investing has been through over the past 200 years, it will give you an idea of some of the things that are covered by the topic, which is originally sustainable investing really came out of religious or ethical investing, not owning businesses where you didn't agree with their practices, whether that was arms, tobacco, gambling, alcohol, whatever like that. And what you've seen is that was the major type of sustainable investing you had over the last 10 to 15 years. But what you've seen much more of a focus on over the last 3 to 5, and really where we are seeing much more of the growth, is in ESG in investing. And that covers a very broad range of topics, but broadly what it is speaking about is focusing on the environmental, social, and governance risks and opportunities of a business, whether that's their products, their supply chain, or how they do business, alongside your traditional financial balance sheet analysis. So that's trying to get a wider picture of what a business is doing and whether it is kind of helping this drive forward in sustainability. And now, separately, but still kind of under sustainability, is impact investing. And the way we see impact investing is it has to have a measurable outcome alongside the investment. So whether that's when you invest in a company, you set a particular target around CO2 emissions or disclosures, there has to be a measurable outcome with the business. And that's really what separates impact investing, in our view, from ESG investing, is the measurability of the outcomes from the business.
Okay, lovely. So a few years ago, when I was a financial planner, we used to do, I have quite an emphasis on ethical investing. So is ethical investing kind of the same sustainable? Is this kind of next generation?
So I would say that, yeah, ethical as in is probably the step before ESG investing from a time horizon period, that it was ethical in that you didn't own things you didn't like. Now with ESG investing, there's a much broader remit to potentially own businesses that might not be doing good in the world, but have the potential to and improve those businesses. And I think ethical was often seen as a best-in-class investment approach. You would only own things that are already doing good or already not agreeing with, or already not producing products you don't agree with. Whereas now with ESG and impact, that very much broadens the scope of businesses you can invest in, because if you've got a thesis of how to improve the business to maybe make it more sustainable, you can have more impact or more positive outcomes for the world.
Okay, brilliant. So that helps clear that up. Thank you very much. Ian, your fund is called a social impact fund. So would you label it in the terms that Chris has just laid out there?
I think I'm happy with that, Chris. I think the key thing about impact for us is that we are looking for a positive social contribution, whereas a lot of the ESG factors, not all, but are about avoiding doing harm or making sure that you run things properly within your own business. Impact we would see as having a positive contribution outside in society, but of course we're also looking for growth stories, and of course we're looking for that EIS qualification as well. So it's not just the positive social contribution. And I think one other thing I'd say is just to dig into it slightly more is we've got 5 things we look at. I won't go through them all, but I think the main ones are the company's actually got a product or service which is making some positive effect. We can talk about the sort of sectors that involves. We're going to look at the scale of the problem they're addressing. So obviously we'd like to see a bigger problem rather than a smaller one. And we want to see innovation. They're doing something different from other people, or they're innovating in some way. So those are some of our impact factors.
Okay, so they're the kind of things you take into account when you're doing your DD on a company and assessing whether they'll be suitable
exactly,
for a particular portfolio. Okay.
Yeah.
And same to you, Max, I guess kind of similar question. When you're looking for companies, what do these companies smell and look like? What are kind of key factors you're looking to find in a social, because your fund is yours a social impact fund? I can't remember, sorry.
So we're calling ourselves a sustainable fund. So we're not specifically using the term impact, but this might be just getting into every investor having their own definition, and impact. I think for us sometimes may indicate that we're concessionary capital. So we're not looking for the same kind of return profile, because we are also looking for some kind of impact outcome, which I don't think those things have to be in conflict. So when we think about it, I think it's kind of helpful to maybe start with the impact management projects framework, which is a global initiative trying to build consensus and a common vocabulary in the space, which is difficult work, as we've already laid out. So they have 3 levels, A, B, and C, of corporate intentions or impact, which investors can use for investment selection. Level A is act to avoid harm. So this is the kind of negative screening that we've talked about. Level B is benefiting stakeholders, where an investor is looking for companies that are intent on improving outcomes for their stakeholders through operational alignment with ESG principles, for example. So this could be ensuring that you're paying fair wages or upskilling your workforce, or it could be reducing the carbon footprint of your supply chain. And then level C is where businesses are oriented around actively contributing solutions. So where you're looking to invest in companies that not only score well on ESG metrics, probably if they're qualifying at this level, then they are also scoring well on ESG metrics, but where the core mission of the company is to promote a more healthy, sustainable planet or society through their product or solution. So we would also assume that these companies will be doing something innovative if it is a new and novel solution, but it really has to be at the core of what they're doing, not just a side project or a conviction to improve processes within an otherwise a driven organization where the product or solution isn't specifically geared towards a sustainable outcome.
There has to be a commitment to it rather than just paying lip service to that in that sense then.
Exactly, yeah, and that's where measurement becomes a really key component.
Yeah, okay, brilliant. So thank you very much. So Abby, finally to you. I know Velocity don't have necessarily a kind of labeled social impact or sustainable fund, but you are signed up to, oh God, I'm kind of failed to remember the charter. Thank you, yeah. I'll let you explain it, that'd probably be easier.
Yeah, so we at Velocity are a little bit different in that we don't have a specific impact or sustainability fund. However, we are signed up to the UNPRI ESG principles. I won't read them all out to you. If you Google UNPRI, you'll find it very easily. But it is pretty much what Chris has outlined previously. Apart from the there is no set measurement, but what that does allow us to do is look at companies within our portfolio and future investments with a holistic view, as in, you know, are they incorporating these ESG principles within their business? So it can be really obvious, you know, is it vegan healthcare? Or it might be something that isn't so obvious, but to us it's still important. So do they profit share with their community? How do they treat their staff? You know, and for us it really starts with the founders. We look very closely at, you know, who set this business up. Do they care about what they're putting out into the world? And you know, because if they don't, then you're never going to get anywhere. So for us, those people also have to embody those principles, and then we take it from there.
Brilliant, thank you very much. Look, so this all sounds very high principled and mission led, and all these fantastic words and very philanthropic almost. But you guys are fund managers, right? You're kind of raison d'etre is to raise money and to get returns to investors. So how do you kind of align those two things to make sure that yes, it does all those brilliant, fantastic things that we've talked about, but also returns a decent chunk back to investors who put their money in this stuff? Who wants to answer that one? Ian, I'll go to you, sorry.
Yeah, I mean, if you picking up on some of the things I already mentioned, if it's an innovative product and it's addressing a big market and it's a big problem, then just because it's an impactful problem doesn't mean that it can't be a hugely profitable one. So we do see a lot of great opportunities. In fact, we had a look actually at when we were setting up the Impact EIS, we had a look at the sort of investments that, just as a benchmark, the VCT companies were making. And we reckoned that actually about a third to 40% of the investments they were making, this is 3 years back or whatever, you could argue were positive impact businesses anyway. So we have cut out a little bit of the investment potential universe. Of course we have, because we want that positive social contribution, but it still leaves a heck of a lot of exciting startups addressing big markets in innovative ways, in my opinion. I suppose the other thing to say, I'm sure one of us is going to mention it at one point, so I'm going to get in, is you know, there's been a huge amount of research done by academics and others over the last decade in particular on whether investing in companies that have good ESG or have a positive impact or are sustainable means you get worse returns. And the findings comprehensively are that you don't. If anything, the returns can be better. Now, we could have a whole seminar probably talking about the details of those sorts of investments, those sorts of studies, and you know, whether they've got flaws and so on. But that is the main message. You can do good here and do well.
But if I understand what you're saying correctly, this has been a trend that's kind of been coming anyway, but is now taken to the fore and really taking off in that sense then.
Absolutely, and I think there's the research on returns to show that it works.
Brilliant. Okay, and Abby, in terms of that trend, I'm going to mention it, sorry, but coronavirus as well. Obviously, has that trend been accelerated by what's happened over the last kind of year or so, or has it held it up in any way, shape, or form? Kind of what's the prognosis looking forward?
I mean, I would say yes, coronavirus has I want to say in inverted commas helped. It's obviously not helped in other areas, but you know, people now have had that time to step back and think, you know, what is my impact on the world? You know, do I really need to buy all of, you know, these extra plastic things from Amazon, or do I want to look to smaller businesses? So, you know, do I want to think outside the box? Do I want to, you know, make a swap in my even, you know, laundry detergent we're seeing? So I think COVID has had great steps forward, and it's also brought, you know, this sort of bringing us back to EIS and SEIS, it's brought a lot more people online. So, you know, people are shopping digitally and they're shopping around. So they get a chance to actually look up, what is this business doing? You know, they're not just in Tesco pulling the first thing they see off the shelf. So from our perspective, we've seen real kind of steps forward in this area. And I mean, in general, what I would say on this wider topic is that, you know, investing in ESG is the right thing to do, but not only that, it does make business sense. Like Ian says, you know, Harvard Business School did I'm going to give you a stat now just to support Ian's theory. Harvard Business School did a study that showed that founders that were diverse actually are made 5% better decisions, or were better decision making, 5% more than those that were not. So if you think about that on a macro scale, you know, it's a huge amount of impact that's, you know, really supports consumer behavior. You know, millennials want to see these new products, and millennials are consumers. So in terms of investing in this area, if you could invest in a company that has these principles at its core versus one that doesn't, you know, why would you not?
I think I'd just add to what Abby and Ian have said is a lot of the flags that you get from doing the environmental, social and governance due diligence on a business aren't necessarily flags about just sustainability. They're about well-run businesses fundamentally. It's if you're looking at a business that manages their climate footprint better, they're less likely to be hit if there's a climate tax or a change in regulation. So they tend to be more forward thinking and more better at planning for the future, which is the type of business that people generally want to own.
Yeah, and I guess we've seen that with Brewdog recently, because they've committed to go carbon zero, I think, haven't they? And they obviously make a big kind of play about their kind of credentials. I guess that's a good point to make, actually. Is a lot of that just a marketing ploy to say, oh, look, we're carbon neutral, with this, that, with the other, and trying to get more investment and get more, obviously, sales for the beers in that sense? Do you feel like it's a bit of a fad at the moment, Chris, or is this a kind of growing trend?
I certainly see this as a growing trend. And I think to Abby's point, what we've seen with COVID-19 and coronavirus is a lot of these trends have been speeded up. People have been online more, they're spending more money, they're able to spend the time to look at businesses a lot more closely. And I think if we look at a demand perspective, and I'm going to use listed markets here just because it's easier to get data on. If you go back to the first quarter of 2020, when we had that huge amount of volatility in listed equity markets, and you had hundreds of billions of outflows from listed equity funds, you actually saw a 36 billion positive inflow into equity funds that have been labeled ESG. So even in spite of that massive volatility and people running away from their liquid investments, demand was still there for ESG, and that was really a trend you saw continue through 2020. And I think the other thing from the conversations I have with many clients is the broadness of the type of client base that I'm now talking to about sustainable investing. It used to be like millennials or charities or people who had a really big ethical focus, but it is so much at the fore, partly down to businesses making so much more noise about it. Everyone wants to talk about sustainability now. Not everyone believes in it. Some people do believe it as a fad, but I think if we look out maybe 5 or 10 years, we probably won't be having a webinar on sustainable investing as a separate topic. I think it will end up being baked into everyone's investment process.
So yeah, it'll come in more into the mainstream, and yeah, it won't be a specialist kind of topic as we're covering at the moment, I guess, in that sense. Okay, so it's probably a good time to bring in for each fund managers here. So Max, Abby, and Ian. I'll go to Max first on this one, but just give us an overview of your investment philosophy, and if you can, perhaps just give an example of one of the companies that you have invested in through the fund.
Sure. Yeah, no, happy to do that. So yeah, just to recap, so we don't describe ourselves explicitly as an ESG fund, and that's just because ESG has become tied up with a whole lot of frameworks and reporting standards, which I think currently are primarily associated with later stages of capital formation. But it's important for us to keep an eye on this because it's indicative of a broader shift in thinking in the financial sector, and because early stage businesses today need to keep this in mind. That's just to say that ESG and its current shifting incarnation may not be the kind of most appropriate term to throw on early stage startups. So we talk about sustainability, which certainly overlaps, but does not necessarily neatly track to the various ESG frameworks out there. Instead, we start with the premise that we're currently facing the largest challenge our species has come up against, not to be too grandiose. But the world is getting hotter, more crowded, social inequalities persist or in many cases grow, and leaving any one of these unresolved prevents us from paving a path towards a more sustainable future. When we think about this, also, we see that there's a collective survival instinct that's begun to kick in from boardrooms to kitchen tables, and this will grow. And businesses that align themselves with this push will be at an advantage compared to those that don't. So for these reasons, these companies have advantages which are multiple, but it probably basically boils down to companies that are aligned with sustainable principles having preferential access to customers, talent, and capital, and I think also in persistence of those of each of those stakeholders in their commitments to working with the businesses. So when thinking about what qualifies as sustainable, we refer to the UN's Sustainable Development Goals as our North Star. We're not trying to reinvent the wheel here. They are the authority on the topic. But in our investment thesis, we've attempted to boil this down to three key themes where we believe they capture the breadth of the mission, while also allowing us to focus on areas where there are venture grade opportunities. So these three themes are technology for planetary health, which would be your carbon capture or climate mitigation, climate change mitigation, but also biodiversity, loss prevention and rejuvenation, sustainable commerce and consumption, and democratizing access for societal needs. And we're not just looking for companies that are trying to optimize their ESG scores, but we're looking for founders and businesses actively trying to build solutions and products for a more sustainable future. And so what we're trying to achieve is to identify companies with a clear sustainability-driven mission, where we can identify a few key sustainable outcomes that are measurable and linked intrinsically to the success of the business, which will have a positive sustainable impact on the planet and society if that business is successful and grows. So in terms of what this actually looks like in terms of investments, I can point to the most recent addition to the Vala portfolio, a company called Good Club. Good Club operates an affordable grocery service for ethically sourced ambient products. So these are not your fresh or frozen goods, like your tin food, pasta, rice, but also household cleaning products, for example. And they operate on an annual membership model, which allows you to shop for a catalog of sustainable products at near wholesale prices, which includes one free delivery per month via a carbon neutral fleet. And the produce is delivered in reusable containers, which you simply leave out for collection the next day. So very much a circular economy play where we are cutting out single-use plastics from the equation and diverting waste streams from landfill. So in terms of how we're measuring that, we're doing some work with them at the moment around quantifying the impact of not only products in their catalog, but also the net impact of their service on waste reduction and emissions as well.
And those companies that you work with, obviously you meet with them weekly, monthly, you tell me how often, but and obviously normally you'd ask about their stats, their revenue, their profit, et cetera, et cetera. Do you also ask them, have you met your carbon neutral commitments, et cetera, et cetera? Is that now part of the kind of DD process that you undertake with them?
Yeah, absolutely. And so there's kind of two parts to that. First is establishing upfront some benchmark of where the business sits today, and we want to understand, from an operational perspective, are they implementing sustainable practices into their processes and into their company DNA. But then also looking at, what is the key impact or sustainable outcome that we're looking for from this business. And we expect to be able to identify a few key metrics that are going to be intrinsic to seeing that mission come to fruition. And that is something that we insist is reported, right alongside their other KPIs as a key metric and North Star guiding that company.
Okay.
And that will then get passed through to our investors in our own quarterly reporting.
Okay, brilliant. I'm picking up a good question for you, Ian, but I'll let you go and explain your investment philosophy first. You want to, again, could you give us an idea of what your take is on this, and also give us an example of a company in the portfolio?
Yeah, sure, Mark. So again, just to reiterate, at the simpler level, for the impact.
Please, simple for me. Yeah, thank you.
Yeah, we're looking for the positive social contribution and the good growth story, which we think often come together. And to get back to one of Chris's points, we try to measure the impact wherever possible. We do attempt at least once a year to put a monetary value on the impact that the companies are having. I think as Chris will know, that's quite challenging, but we give it a go in order to give a bit more information to our investors about what impact they're having, and hopefully as the businesses grow, they have more and more measured impact over time. And a bit like Max, we have we kind of manage it by having some themes. Again, they're based on having looked originally at the UN sustainability goals and trying to capture as many of those goals in as few sectors as possible, and kind of the sectors and themes that we came up with. And it's not rocket science, but where we focus is healthcare, the environment, children and education, and a little bit of a catch-all with one we call inequality, which could be companies not necessarily dealing with income inequality. It could be inequality of access to bank accounts, for example, or to fair energy prices or whatever. So those are the sort of high-level themes we address. We have a bias to companies that are technology, particularly software-driven, not exclusively so. We do have some consumer companies, but we like the software because if the companies get it right, they can scale that very quickly. That gives us the growth, that gives us the scale of impact as well. In terms of examples, there's kind of any number. I'm going to mention one where actually measuring the impact might be slightly trickier. There's a company we've invested in 2019 called Cyan Forensics. It's a university spin-out in Scotland. Don't worry, not all of our investments are Scottish. Only one of them is. Like to find more. But it's a university spin-out, and it's a software business. And their software helps, in the first instance, the police to scan devices like PCs and iPads, etc., tablets, and now phones as well, for illegal images. So in the first instance, what the police are interested in is images that may be illegal images to do with child sexual exploitation, but this may also cover terrorism as well. The company got a large contract from the Home Office to roll the software out across UK police forces. That clearly has a positive impact in terms of saving police time, because they can scan the devices much more quickly than with their traditional software tools, suspect devices. But the big potential market there would be in social media companies, which of course they face the private sector. They face huge challenges with potentially illegal material being loaded onto their websites in all sorts of areas, and the company are now starting are talking to their first customer in the social media area. So that is an example.
Okay, brilliant. Thank you. A question I was cooking up, and by the way, thank you. I see a couple of questions are coming through in the Q&A in the chat, so please keep them coming through, and we'll answer those at the end. The question I was going to ask you, Ian, was if you had a company, and science probably not a good example, but if you had a company that was meeting all of its positive social contribution kind of commitments and measurements that you've talked about, but wasn't getting the revenue you wanted them to get or getting the profit you wanted them to get, what would you do? Would you follow on your investment in that company? Would you still be kind of happy with that company?
No. I mean, this seminar is about ESG, sustainability, impact investing, but the first reason is the financial return. We're not doing charitable business with our clients' money. We're trying to make a return. And our view is, as I said before, and Abby touched on it as well, that we can make the same returns as non-impact focused funds, but we can also go for the impact. But yes, if it's doing badly financially, we're not going to follow on our investment.
Yeah, thank you. I thought I'd just clear that one up. Thank you very much. And Abby, over to you again. Investment philosophy. If you have a good example to give us, that'd be brilliant. Thank you.
Sure. Again, so I think I have the easy job because we are not, specifically mandated in this area. So again, we look at the company overall. So like I said before, is the product specifically kind of ESG product? If it is, then that is great. But again, we still look at the management team, and from that we take away. So we meet them 6 to 12 months before we make an investment. So you really get a sense of, and this probably answers a question. I think it was Nick in the chat asked about ESG washing. Can people just pretend to do this to get investment because they see it as an area of increased interest from investors? And it's really hard to fake something over that amount of time. It'll become very clear. And to us, I mean, we see a huge number of businesses that come through in our deal flow, and straight off the bat, you can see if the product isn't really there, then and then when you speak to the founders, you can see very quickly what type of people they are. Do they really care?
Sorry to interrupt, Abby, but in those pitch decks you're seeing then, are you seeing a lot of companies who are trying to kind of push their ESG credentials because they know it's a bit of a buzzword, it's a bit of a kind of button for you to press at the moment?
No, not really. I would say if their product is geared that way, then yes, they are. So we have a new investment coming on, which is kind of organic, vegan, sustainable household items. So that obviously, they don't really need to amp up, although they do. But then it's when you meet the founders and they'll tell you small bits about how they operate, how they treat their stakeholders. And for us, that is just as important because it is a social impact. And to Ian's point about we do have to remember that there is a G in ESG. So governance, we do this, anyway, we're in a financial services industry. However, we are then handing that money over to those founders, and they have a governance responsibility to manage it properly as well. So we need to know that they can do that.
And it's a G where you come in as well. Is that part of the governance factor that you're offering to that company? Yeah,
so particularly in finance, and the guys on the panel will know this is probably as well as I do, your SEIS and EIS businesses are not necessarily finance driven. They're driven by their passion, their product, and they really need kind of as much financial advice as they can get at this stage, and can't necessarily afford to have the best financial, well, they can't afford it. So yeah, I will spend a lot of time with businesses in our portfolio, making sure that their model makes sense. I mean, we do this as part of our DD anyway, but sitting down with them, seeing what works in terms of their margins, can they improve anything, when there's tight times, I spend a lot of time telling them how to deal with their suppliers, stakeholders, kind of pushing cash lines and things like that to get them to a point that they can then run with their business and feel a lot more confident with those financials. A lot of time they can just be floundering without the education. And then a business in the portfolio that I personally I'm really proud that it's in our portfolio is called Sonic Jobs, which is it's a CV builder for blue collar workers. So it's an app on your phone. You don't need a laptop, or you don't need Word or PDF. It's a chatbot. So these blue collar workers will say what they've been working on, and it will create them a CV that we would expect to see, in the white collar jobs. And then it makes that CV for them, and then will recommend kind of, you've worked as a shop supervisor in Tesco. Those skills are transferable somewhere else. So you could work in, obviously not at the moment, but you could work in hospitality. So it actually matches then their skills that they might not have thought that they could go and do. And they've done really, really well during COVID. So there's a lot of people that repurposed as they were in hospitality, they're now delivery drivers, they're now working in warehouses, and to the point that they'll be doing a Series A this year. So, that's what we're talking about with these products that we invest in. That's the impact and the financial gain.
Yeah. Initially, I thought when you said CV builder, I thought you said CD builder. I thought that doesn't sound very future focused. That's
it's not really advanced, but
Chris, obviously you've heard from kind of three fund managers in the EIS field. I know you don't have an EIS fund, but you do obviously a lot of investment in this area. Is that all kind of chiming and resonating with what you see elsewhere in other products that have an ESG or sustainable?
Yeah, and I think so much of what ESG investing comes down to, or sustainable investing, is due diligence. And whether that's you're investing in these early stage companies or you're investing in listed public market equities, when you go to a manager and you want them to do ESG or sustainable, you need to make sure they have the track record, they are actually doing that due diligence. And the questions really around greenwashing are, how do you make sure that a business isn't greenwashing? And the only way you can do that is to have a manager that does the enhanced due diligence and has the track record of looking at these businesses. Because if you don't have that track record, when you see a lot of demand in the area, of course there's going to be people coming into the world with a new product to say, yeah, I've got a great sustainable fund, but I have no track record. That should often be a red flag for investors. And the other point would be that if we're looking at sustainable investing as a growth area, then what you want to see is there's going to be different approaches, and there's not going to be a right answer about whether a company is sustainable or not. You might get three different fund managers like we have on the panel. They might all look at a business and they might come up with a different belief of whether that is a business that hits their criteria for sustainability or to make it into their impact portfolio. And that's one thing that investors are going to have to get comfortable with. And it's a lot more obvious in the listed equity space. And to use an example that we saw in the summer, when you had Boohoo and their issues in their supply chain in Leicester, you found out they were in some fund managers, sustainable funds, you found out they weren't in others. There's always going to be that gray area. And I don't think any fund that badges themselves as sustainable impact or whatever is immune from what I call a sustainability blow up, because you can do all the due diligence in the world, but it doesn't necessarily mean you'll always uncover everything there is about a business.
Yeah, due diligence is only as good as the information you're getting back from the company you're asking the questions to, isn't it? So yeah, these things do come out in the wash further down the road sometimes, don't they? You mentioned it's obviously a new area of investment for investors, but also I guess for financial planners and financial advisors who are probably watching this right now. What kind of advice would you give to any financial planner who's kind of starting to look at this area or dipping their toe in the water for this type of investment? How do you go about it? How do you compare all these fantastic fund managers or propositions? Where's the starting point, really?
Well, I think it's first and foremost, it needs to start with the client, and you need to understand what your client is actually expecting out of ESG, impact, sustainable investing. Because I think often when people talk about sustainability, the first thing they imagine is climate change. And often when you find out you're investing in a sustainable fund, you think you can't possibly imagine that you'll have anything that is polluting or carbon intensive. But often what you find is that actually those businesses often are employers of low skilled or low paid workers. So the social impact you can have is pretty high. And there's sometimes a trade-off between businesses, between the good from the E compared to the good from the S and the G. So you need to understand what your client is expecting from their manager. And then really it's a case of going out and looking at what managers claim to do, trying to speak to them and find out whether their example companies are what they are delivering on the ESG and what they're talking about. And also, if you can, try and find out what managers are invested in, but they aren't showing you in the first instance. Because I think that the first business that someone's going to talk to you about in their sustainable portfolio, and this is going to sound like I'm casting aspersions here, so sorry about this, other panelists, is going to be the one that ticks most of the boxes. But it's going to be the one that's sort of at the back of the marketing deck or not mentioned at the forefront that will be the one that is probably the furthest away from their investment process, maybe. And so that, to keep harping on about it, but it is that due diligence and understanding what the client needs and what the manager does that I would say is your starting point for.
Yeah, I guess that kind of throws down the gauntlet to these fund managers.
Sorry about that, guys.
So yeah, Ian, in terms of that, obviously Chris has mentioned the gauntlet being thrown down there, but what sort of messages would you like to give to financial planners to kind of assuage their fears or about the DD points that Chris has made just there?
Yeah, I mean, I think well, we would just be upfront about the fact that because this is an impact fund, so it's obviously a higher hurdle. Well, it's not obvious, but it is a higher hurdle than ESG, in my opinion. We are being pragmatic. It's relatively, although, we had a question earlier about is it a fad? I mean, in the stock market, I do worry a little bit that it's become a bit of a bandwagon. I was being a man in my mid-50s, I do have a pension fund, and I was looking at a fund that I was invested in the other day, and suddenly it had the word sustainability put on the end of its very, very long existing title, and I kind of, hang on, what's going on here? But in our world, I think it's still relatively early days in the venture world, in the EIS world. And so we are pragmatic. Our companies, we will go through the process. We'll look at our 5 factors. We want to believe there's a positive social contribution, but we will be reasonable. We're not going to invest in something that we think is doing harm, of course not, but we will be reasonable in making sure the investor gets a portfolio because they're also interested in getting deployed, and getting their tax relief, let's be frank. That's the main initial interest in EIS, and in getting returns. So if we see a great business which is less impactful, but we think we can help them become more impactful. We're looking at one at the moment, for example, which is an ethical jeweler, which is a bit more marginal than Cyan Forensics than I talked about. Then we'll look at investing in them. I'm not sure if I've answered the question, but that's what I wanted to say.
You neatly sidestepped it, but it's fine. Yeah. That's fine. It's about 1:45, so I know there's a few questions that have come through. So perhaps we can turn to those. That's okay. And I think Nick, that Abby answered your question in the chat earlier, so hopefully that has. If it hasn't, please put something else up. But,
I mean, there was actually one other thing that came up on the chat, which was, aren't these companies pretty small for ESG? And I think that, we're focusing on impact. Max's angle is sustainability. On the ESG, we do also score them. We have a simple way of scoring them on ESG, but of course, some of these are very early companies. We have to be reasonable. They don't all have massive data protection and employee handbooks. Generally, actually, young companies, because of the interests of the founders, often do have very good policies in these areas, but we can't expect them all to have. What we need to do is make sure that they are heading in the right direction and help them, as Abby was saying, to develop these over time as they grow.
Yeah, I think there's a question that came through before we started, but Max, perhaps it's one for you, because you're talking about EIS. Is EIS and SEIS kind of a natural fit for this type of investment? Is it something because obviously normally we're kind of fintech focused or tech focused, and this is slightly outside of that. So is this a natural home for this area?
Yeah, absolutely. And I think as I alluded to before, this, and as we've covered on this conversation, either ESG or sustainability, however you want to frame it, we're not talking about an area of investment. We're talking about implications across the entire market and across all sectors of the economy. So I mean, just if you look at the fund universe, it's forecast that by 2025, more assets under management than not will have some kind of ESG screening incorporated into their processes. So any company that's starting out today that doesn't have an ESG strategy is behind the curve and needs to catch up. Similarly, with sustainability, we're talking about a transition of the whole economy towards something that is enabling us to live and thrive in perpetuity with our co-inhabitants and with the planet. So this is more than just a niche corner of the investment universe. This is something that requires a full transition. And when we're talking about transitions, entrepreneurs are always going to be core to any kind of economic transition. They will be leading the pack. We need new solutions. And that means that EIS and SEIS are a natural place to be incorporating these ideas and looking for opportunities. So absolutely, I think that whatever you're calling it, whether it's ESG or sustainability, there's a natural home in EIS.
Brilliant, thank you. Ian, I'll come back to you for this question. Abby, I'm not ignoring you. I'll come back to you for a question in a minute, don't worry. But it's kind of going back to one you just mentioned really about these companies are early stage. How do you it's really difficult to judge their success in terms of their kind of credentials in this area. So ultimately, are you looking, is it profit first and ESG second, or is it the two together? What's kind of the dividing line there?
I guess the first thing we look at is, does it have the positive social contribution, and we then probably will meet the company. But the initial screen after that is this a good business?
Yep.
So it's both basically. Yeah. Brilliant.
Short and succinct answer. I like those. Thank you very much. Abby, I did warn you I was going to ask you a question, so I'll come back to you. Again, another question from Dennis. Thank you for the questions, Dennis. It's really asking about returns for investors. Fund managers talk about 2 times return or 3 times. Some talk about 10 times. Some talk about 15 times. Some talk about 5 times. How do you judge that a company has, as Dennis has put it, the X factor?
I mean, so many factors. I mean, I guess we look at our deal flow first and foremost. So you can very easily from that look at a deck and think, is there a market for this? And I mean, at the moment, I am completely talking outside ESG. Straight away off the bat, you look at the decks and you see, I really like this product. So we would look at it from, is there a market for this product, regardless of what has been done with it so far by that team. Our modus operandi is to take what they have and, super scale it, help them reach the market that they need to as fast as they can. And it has to be that product that you can just, I hate to say this, but it's a real art. Like you get a real feel for it. And then when you meet the founders as well, so it's those two things. Like if they have a terrible product, it's never going to work, regardless of, I think Ian said, regardless of how much impact it makes. It's not the G, like the governance point wouldn't be there. It'd be foolish. So the product, but also the management team. Can they, because we can't be there day in, day out with them. We can help them get there, but the management team has to be the one that can get them to that place. Those two things together, we think we can help give them all the expertise they need to get to that point. But those two things have to be there. in the first
so it's a
instance.
kind of hand-holding message in that sense. And you said that
Yeah.
it's not an art, but is that the alchemy here, that it's partly art, partly science, and that kind of they're giving the art part, and perhaps you're doing the science part in terms of the DD and the financials, etc.
Yeah, and we look at it from, so our team are, you know, multidisciplinary, like I guess it will be the same with Ian and Max. You know, we all look at it from our own different points of view. We are pretty diverse ops team as well. So we will sit and, you know, we all have to believe. So, you know, it can't just be one person saying, no, it's going to be great, you're wrong, because, you know, that is a marketplace right there in front of you to do the initial testing on. So yeah, that's kind of how we get the feel. I'm sorry that I can't give you a scientific answer.
That's how the magic works.
Yeah.
Yeah, well, if I can just throw in on
Yeah.
that, I mean, to slightly reiterate some of what Abby said. I mean, I mean, obviously the first thing we see are decks, but in the meeting, the key thing is the founder or founders, and whether we believe they can, you know, deliver the business plan. And then I already mentioned that for the positive social contribution, we need to see a big market. That's the same for the growth side of the equation as well. The quality of business, we need to see a big market there, and what traction or customer engagement they've already got, and speak to some customers. How have they used resources already? You know, if they've raised a few $100,000, have they done a lot with that, or have they spent it all and not really got anywhere? These sorts of factors.
Yeah, so again, probably no different from what you were doing if it wasn't a social impact fund, or it's just
those factors. Those are the factors that are the same for our other venture fund, which is not impact. Yeah.
Brilliant. And Max, there's a couple of questions here that I'll perhaps throw at you that Declan's very kindly sent in. So it's really around like on the ESG. How do you measure your ESG criteria in your initial DD, and then kind of taking out the environmental part, which is perhaps the easiest part to measure? How do you measure the social and governance side of it?
Sure. So again, we're not specifically an ESG fund, but obviously we do want to see that companies are operating with best practices, and that they're not doing harm through their business practices. So in terms of what we do up front, we similarly use a fairly streamlined and size appropriate approach. We typically ask companies if they're willing to take out a B impact assessment, which is a industry standard tool, which you can be as detailed or not in your approach to it. If companies choose, and if they score well, they can go for a B Corp certification, which is a nice indication that they are committed to ESG principles, and that allows us to keep things somewhat standardized. But again, I would kind of go back to I think Ian was referring to this, that these are very early stage companies, and for a lot of ESG, which is in cases a compliance tool, throwing these standards at them is just not a great use of the company's time, and you're not getting the greatest amount of information that's useful out of it. So what you really want to understand are these founders who are going to incorporate these practices and are committed to using best practices going forward, and are they willing to work with a manager who can help them on that journey to incorporating these tools and these frameworks at the appropriate time. Because if you have a company with 5 people today, you're targeting an exit where probably it's more in the dozens of employees that they have, or hundreds even. So it's going to look very different, and there's a lot of time for them to shape that. But what's really important is does the founder have a commitment to building these practices and these commitments into their organizations going forward?
I think. Oh, sorry, carry on.
Oh, sorry, no, go ahead, please, Chris.
I was just going to add that when you're looking at EIS and SEIS investments, the type of information you're going to be able to get out of them is going to be very, very different to once you get to a company with 200 employees, once you get to massive mega corporations, because that focus from investors is much, much higher when you get further up the market cap spectrum. And so the need to do the disclosures on your carbon footprint or your supply chain becomes much more intense when you have many, many more investors looking at you, so that you have to do that. Whereas when you have a business like Max was saying that might only employ 5 people, you simply won't have the resource, the time, or the money to give all of the disclosures that a large company will be able to do.
On that same point, Chris, I was going to ask, so thanks for jumping in, but obviously when you're a small company, as the guys have mentioned, it's difficult for them to measure how much perhaps their commitment is at the moment. But when they become a large company, how easy is it to keep up that commitment to what all those things they said they were going to do when they started off? When you've got 200 people you employ, you've got X, Y, and Z to be managing in the business. How difficult is it, or how easy is it?
It really will depend on the business's commitment to disclosing these sorts of things, because the regulatory requirement for disclosures right now, even in the large cap space, is, in the really mega cap listed, is pretty low. So it's really coming from the pressure from the investor side to find out this information to make businesses disclose and disclose more, because you're seeing it's having a direct impact on cost of capital. Those businesses that aren't willing to talk about these things now are more likely to have more expensive cost of capital going forward. So there's a natural kind of push from your cost of capital to do it. And I think the way we're likely to see things heading is, from a regulatory standpoint, more and more is going to be forced upon businesses to disclose, but there's also going to have to be a big push for standardization of what is disclosed, because right now how one business talks about their carbon footprint compared to another is very different, and that makes it hard for investors to make it comparable. You might look at two businesses in the same sector, but the way they're disclosing their water usage, their carbon footprint, is completely different. And that makes it very hard as an investor who analyzes the business to say, well, actually, these two things are comparable. And in a way, that's one of the benefits when you look further down the cap spectrum at these earlier stage companies that all of these guys are looking at, is you get much more direct access and you can ask the questions. They might not have the answers, but you get a better feel for the business than you do as someone trying to buy BP and understand exactly what their carbon footprint is, even if they do loads of disclosure.
Yeah, I'd be interested to see what the regulator does in this area, because I know the FCA like to see things kept simple and easy to explain to investors. So I'd be interested to see what road they go down. Look, we've got 3 minutes left, so that's probably 1 minute each for each of our fund managers. So I'll give them kind of last speak on this. And it's really just, I say the webinar series is called Tax Year Ends, and new ideas for the tax year end for financial planners. So in a minute, Ian, can you just give us kind of a couple of ideas as to why investors, why financial planners should be looking at this area of investment?
Yeah, I think when we started the Impact EIS service 3 years ago, it was actually very cutting edge, especially to go impact rather than ESG. But we have seen increasing numbers of end clients who are interested in this. I think they like to feel that there's a large number of clients who like to feel that they are doing a bit of good, as well as taking their tax benefits and maybe hopefully getting a financial return as well. And so I think this has become more topical. Obviously, I don't think in our area it's kind of become a mania. Maybe it's kind of happening in the stock market. In our area, it's still relatively early days. I'll tell you when the fund gets to 100 million mark. Then I'll tell you there might be signs of a mania. But for now, there's lots of great opportunities to invest in companies that are doing good and are great business models, and you can get that through our Impact EIS service. That's the sales pitch.
Okay, so feel good investment. Max, up to you. 1 minute.
1 minute. Well, I mean, why should investors care? I think investors already do care, and I think that for IFAs that are advising their clients, this is very much the direction of travel. And I don't think that this is a fad. I don't think this is going to be walked back. I think there is just more of a commitment from investors, from consumers, from regulators towards ensuring that businesses are driving sustainable outcomes and using sustainable practices, and businesses that are driving sustainable outcomes are going to benefit from that momentum. So I think it's not only that it's the right thing to do, it's not only that if you're not incorporating ESG principles into your investments, you're falling behind the curve and missing a trick, but it's that there is an opportunity to both seek enhanced returns on your capital while investing in companies that are doing something good for the world. So I think it's kind of a no-brainer to be incorporating ESG principles. It's good business sense to be looking for companies building sustainable solutions, and I think that will become more and more obvious over the decade.
Brilliant, thank you very much. Abby. Last minute to you.
Yeah, I'll be very quick. I mean, from an investor point of view, you think about it from the consumer's point of view. And, you know, as we continue 5, 10, 15 years down the line, consumers are becoming more millennials, Z Gen, you know, they want and expect it. Therefore, you should be investing in the things that your consumers, you know, and your future consumers want. And if you get in early, your returns are likely to be much higher.
Brilliant. There's one question that's come in that requires a one-word answer from each of you. So it's a question asking about how many companies are you going to be investing to this tax year?
8.
8 for Ian. Max?
6 to 8.
6 to 8. Abby?
New, same, 6 to 8, I think.
6 to 8. Thank you very much. Dennis, I hope that answers your question. So thank you very much, everyone. Thanks very much for attending in today. We are back again tomorrow, 10 o'clock again, same time, same place, literally. And tomorrow's focus is on SEIS. We don't really shine a line too much on SEIS, so we thought we'd time to rectify that. So we'll be all things SEIS tomorrow. Please do join us for that. Just leaves me to say thank you very much to all our panelists, to Max, to Abby, to Chris, to Ian. They are all available should you wish to find them. Send me an email if you need to, and I can put you in touch. Thank you very much, panelists. Take care, and we'll see you soon.
Thanks, Mark.
Thank you.